For decades, we've been sold this idea of a safe retirement. Just put your money in a simple mix of stocks and bonds, the 60-40 portfolio, and you'll be all set. But what if that advice is not just old? What if it's flat out dangerous in today's world? Today, we're not just going to question that old model, we're going to explore a totally different way of thinking about how you build wealth.
So let's just cut right to it with a question for you. Think about your 401k, your IRA. Is it really built for the economy we're living in right now, or is it based on ideas from like the 1980s? So many of us are just following this old script, this boilerplate investing plan, without ever stopping to ask if the rules of the game have changed. It's time to wonder, is your financial future just on autopilot, cruising toward a place that might not even exist anymore?
All right, so here's our game plan. First, we're going to blow up the myth of the so-called safe portfolio. Then we'll dive into what I call the great diversification delusion. After that, we're going to make a huge pivot to a new mindset, all about cash flow. We'll lay out a disciplined 4 pillars framework. I'll show you what a new kind of portfolio actually looks like, and then we'll wrap up by talking about how you can start designing your own blueprint. Let's do this.
Okay, part 1, the safe portfolio myth. This is all about why that standard, one-size-fits-all advice you get might actually be setting you up for a world of hurt. We're taught to believe it's the only smart move, but you know what? The world has changed a lot.
This quote just hits you right in the gut, doesn't it? I mean, think back to 2008. People who did everything right and were about to retire watched their life savings get vaporized. Poof, just gone. Their 401ks were completely tied to the market going up, what we call capital gains. So when the market tanked, they had nothing else. No other engine in their portfolio, no income stream to pay the bills. It was a disaster.
And if you think that was a one-time thing, well, this is where it gets a little scary. Look at this comparison. On the left, you've got Japan's story. They had a huge housing boom, then a bust. Their economy fell to pieces. Their big idea to fix it? QE, or QE, which is basically just a fancy term for printing a ton of money. And the result? Their market went absolutely nowhere for over 30 years. Now, look at the right. The US in 2008. Housing boom, then a bust. Economy falls to pieces. Our solution? QE. QE1, QE2, QE3. It's almost the exact same playbook. So the big question is, why on earth would we expect a different result? Are you really willing to bet your entire retirement on this time it's different?
So that leads us right into our second section, the diversification delusion. We have all had this drilled into our heads. Don't put all your eggs in one basket. It's pitched as the ultimate safety net. But what if it isn't? What if it's just giving us a false sense of security?
Yeah, you heard me right. How can diversification be dangerous? Well, it's dangerous when you think you're safe, but you're actually exposed to the biggest risk of all. That's a bad spot to be in because it makes you complacent right when you need to be paying the most attention. To get why, you got to understand there are two kinds of risk. On the right, we have non-systemic risk. This is when one specific company has a problem. Maybe the CEO gets fired or there's a huge product recall. If you own 30 different stocks and one goes down, the other 29 can help soften the blow. That's what diversification is supposed to do. It protects you from a problem in one little cabin on the ship. But on the left, you have systemic risk. This is when the entire system is in trouble. A massive economic crash, a global pandemic. This time, it doesn't matter if you have 30 stocks or 300 stocks. The whole ship is sinking.
This analogy just nails it. A flu shot is great for protecting you against the flu, but it's not going to do a single thing for you if you get in a massive car wreck. Diversification is the flu shot. It protects you from those little non-systemic problems, but it offers almost zero protection against the big one, the systemic car crash. When the market really melts down, all those supposedly diversified things, they all go down together.
Okay, so we've poked some pretty big holes in the old way of thinking. Now for the good part. Let's pivot to the solution. And it all starts with a huge shift in your mindset. We have to stop being obsessed with our net worth and start focusing on something else entirely. Generating income, or what we call cash flow.
This slide makes it super clear. On the left, you've got the capital gains model. The best way to think about this is flipping a house. You buy it, cross your fingers, hope the price goes up, and then you sell it for a profit. That is the buy low, sell high game. It's exactly what your 401k is trying to do. Now look at the right, the cash flow model. Instead of flipping the house, you buy it and rent it out. You get a check every single month, whether the value of that house goes up, down, or sideways. The goal isn't to sell it. The goal is to get paid to own it. See the difference?
The hard truth is that your 401k is a pure capital gains machine. Its value is totally at the mercy of the market's mood swings. And yeah, some of the funds might pay dividends, but those are almost always just reinvested to buy more shares to chase more growth. You're not getting a check in the mail you can actually spend. And the worst part, you have basically zero control. You're just a passenger along for the ride, hoping the driver doesn't crash.
Okay, so this brings us to a much more proactive way of doing things. If we're going to focus on cash flow, we can't just wing it. We need a system. And that's where the 4 pillars framework comes in. It's a disciplined, repeatable process that replaces guesswork and that old boilerplate advice with an actual structured way to make decisions. So here they are, the 4 pillars. Number 1 is fundamental analysis. This is just digging in to see if a company or an economy is actually strong. Number 2 is technical analysis. That's looking at the charts to see what the market itself is doing. Is the timing right? Number 3 is cash flow. These are the actual strategies we use to get paid. And number 4, this is probably the most important one, is risk management. That means you always have an exit plan.
Let's break it down. Fundamentals tell you what to buy. Is it a good company? Technicals tell you when to buy. Is the price right? Cash flow shows you how to get paid while you own it. And this is key, whether the market is going up, down, or just sideways. And risk management? Well, that's what keeps you in the game. When you put all 4 of these together, you stop being a passive investor who just hopes for the best, and you become an active, educated pilot of your own money.
Okay, so theory is great, but let's get into the nitty-gritty. How do we actually use this to build something different? This is the what I'm doing instead part. We're moving from the why to the how, and looking at a portfolio that is built from the ground up for one thing, generating cash flow.
So here's one way it could look. And notice how different this is from that old 60-40 model. First, we've got 50% in core investments. These are your high-quality, long-term assets. But then, look at this. A huge 40% slice is dedicated to active cash flow strategies. These are the engines that are constantly working to bring in income. And this is so important. 10% is just sitting in cash. Why? Because cash is opportunity. It's your dry powder. It lets you go shopping when everyone else is panicking and forced to sell. So what's an active cash flow strategy? Well, this is a perfect example called the wealth wheel. It's a brilliant cycle for creating multiple income streams from just one single asset. So step 1, you can get paid to agree to buy a stock you already like, but at a cheaper price than it is today. It's called selling a put. If the stock drops to your price, you have to buy it, but hey, you got it on sale. If it doesn't drop, you just keep the cash you were paid. Free money. Step 2, once you own the stock, you collect any dividends it pays out. Then step 3, you can basically rent out the shares you own for more income. That's called selling a covered call. And then you just rinse and repeat the whole cycle, constantly bringing in cash.
So the whole portfolio is built with these parts. You've got your core investments as the foundation, solid, dividend-paying companies. Then you have the cash flow strategies, like the wealth wheel, working as your income engine. You might even use a tiny slice for some speculative plays. Higher risk, sure, but with a strictly controlled downside. And the thing holding it all together is risk management. That's non-negotiable. It means you never get into a trade without knowing how you'll get out, and you never risk so much on one idea that it can take you out of the game.
And all of this brings us to the final, and honestly the most important section, designing your blueprint. This is about taking all these ideas and making them yours. It's about getting away from the cookie-cutter plans and building something that's actually designed for your life and your goals. I mean, this quote is kind of funny, but when you really stop and think about it, it's also incredibly sad and true. We'll spend hours researching a new phone, but when it comes to the plan for our entire retirement, we just sort of hand it off and hope for the best. Having a written financial plan, a real blueprint, is one of the most important things you can ever do for yourself.
Ultimately, this is what it's all about. It's a complete shift in who you are as an investor. You stop being a passive passenger in the back seat, nervously hoping the driver knows where they're going. Instead, you move up to the pilot's seat. You learn to read the instruments, the fundamentals, the technicals. You learn how to navigate using cash flow. And you always have a plan for turbulence. That's your risk management.
And that really is the final choice, isn't it? Let's be honest. Hope is not a strategy. Just closing your eyes, crossing your fingers, and hoping the market goes up for 30 years, that is not a plan. The other option is to build it, to lay a foundation of education, to put up a structure with a disciplined framework, and to create an income-producing machine piece by piece. So the question is, which one are you going to choose?